Ever wanted to own a super rare NFT but can't afford it? Well, did you know that you could own a share of one? That's all thanks to NFT fractionalization. Today, I'm going to tell you everything you need to know about this NFT practice. I'll also be taking a look at some of the potential risks that could come along with it. So, if you were considering buying a share of an NFT, this is a video you can't afford to miss. Before I can tell you all about fractionalized NFTs, there are a few terms and conditions to which you must agree. Nothing in this video can be considered financial advice, and I won't say that twice. It's just educational, informational content with a bit of added spice. Now, if I'm unfamiliar to you, my name is Guy, the crypto YouTube dude. We cover news, reviews, coin overviews, market moves, and NFTs too. If this sounds like what you're after, then subscribe to the channel and ping that notification bell to make sure you never miss out on any of my crypto banter. If you're a little short on time, you may skip around using the timestamps in the video timeline. If you can watch from start to finish, well, even better, because it will help this video get found by other go-getters. Okay, that's quite enough of splitting hairs. Let's split some NFTs instead. While non-fungible tokens have taken the world by storm, there are a number of challenges that the sector faces that will limit its ability to gain mainstream adoption. Up until now, uniqueness and provable scarcity have been NFTs' main selling points, but despite their unprecedented success, the NFT market remains a rather illiquid one. This extensive illiquidity, inherent in the NFT ecosystem, is a major issue. This is because NFTs, which are mostly represented by Ethereum-based ERC-721 token standards, are non-interchangeable with one another, which makes the process of trading them natively complex and their markets far less liquid. Fundamentally, all this does is limit access to broader audiences, which include retail investors and smaller collectors. And the majority of high-end NFT assets are either too expensive or, more often than not, off limits for most investors in the space. On top of that, apart from illiquidity, the NFT ecosystem faces many other drawbacks that are limiting its widespread adoption, namely market speculation, regulation and copyright issues, lack of security protocols, environmental sustainability, and a lack of efficient storage systems. Now, I would argue that these technical constraints have potentially inhibited NFTs from gaining the exposure and liquidity required to develop into a fully fledged, sustainable digital asset ecosystem. But the new NFT model that I'm about to shed light on could be a solution to these limitations, and that is the fractionalized NFT, or F-NFT. So, let's see what this model entails and how it works. NFT fractionalization is a relatively young concept in the digital asset space. Technically, NFTs are unique by design, which means they can have only one single owner at a time. Hence, the concept of F-NFTs came into existence to allow NFT owners to mint tokenized fractional NFTs and share the ownership of the asset with others. In fact, more often than not, a high-value asset like real estate, a luxury yacht, or a piece of fine art will be impossible for everyone to own. And this is precisely where NFT fractionalization can play a role in enabling individuals to invest a small sum of capital to gain partial ownership of a high-priced asset. With F-NFTs, anyone can theoretically now own a piece of a high-value asset at a considerably lower cost, a process that could potentially ignite and open up an entirely new economic framework based on shared, democratic ownership of valuable assets. Now, I don't wish to dive too deep into how the native architecture of an ERC-721 NFT can be fractionalized or subdivided into multiple components, as the smart contract procedure here is, unsurprisingly, pretty complex. So, put simply, when an NFT undergoes its fractionalization process, the underlying asset is first locked in a smart contract. This smart contract then splits the originally indivisible ERC-721 NFT into multiple fractions in the form of fungible ERC-20 tokens, with each fraction representing partial ownership of the ERC-721 NFT. Shareholders will now be able to own a fraction represented by an ERC20 token of the NFT, which equates to owning a percentage of the original ERC-721 asset. These ERC20 fractions are typically put up for sale at a fixed price for a specific period of time, or until they sell out completely. There are quite a few fractionalized NFT marketplaces in existence at the moment. But given how niche this emerging sector actually is, these marketplaces haven't really gained that much social traction as of yet. That being said, fractionalized NFTs are of particular appeal, at least conceptually, as they offer a variety of interesting benefits to their users and holders. Picture this, for instance. Imagine a scenario where we could fractionalize, say, the Mona Lisa. Let's now suppose that this admittedly priceless work of art was valued at $1 billion and was represented on-chain as an ERC-721 NFT. Now, given the incredibly high price of the piece, only a small number of investors and collectors could possibly afford to bid for it. If, however, a smart contract were to fractionalize the Mona Lisa NFT, each fraction would then constitute a tradable and more affordable ERC20 token. This, in turn, would allow every fraction owner to use their ERC20 tokens to buy, sell, or auction off their share of the previously invaluable NFT, inherently making the asset more liquid. Based on my research, there appear to be three major benefits to NFT fractionalization: price discovery, asset liquidity, and democratization of investment. So, let's take a look at these. With NFT fractionalization, a new price discovery procedure can be put in place to produce a price estimate for each and every ERC20 fraction, which then allows for an overall valuation of the underlying ERC-721 NFT asset. Secondly, NFTs are distinguished by the fact that they possess unique, one-of-a-kind characteristics. However, one of the most pressing issues when it comes to NFTs and NFT trading is the generally illiquid market that encapsulates them. Thus, NFT fractionalization was created and designed to address the lack of liquidity that exists in secondary NFT markets. And when an NFT is fractionalized, the ERC20 tokens representing each NFT fraction could be traded on DEXs or even centralized exchanges, thus increasing the asset liquidity of the NFT itself. Thirdly, given the high prices for some top-tier NFT collections, this naturally inhibits smaller investors and collectors from participating in NFT auctions. Thus, breaking up a high-end, expensive NFT into multiple fractions lowers the barrier to entry and ownership costs, essentially enabling more investors to gain exposure to the market of prestigious NFTs. In theory, NFT fractions could therefore democratize access to the broader NFT market and allow even the smaller investors out there to gain a stake in some of the priciest NFT collections. In addition to this, with advanced fractionalization structures, NFTs could, at some point in the future, provide an avenue for onboarding real-world assets with intrinsic value, such as real estate, for instance, onto DeFi platforms. This would expand the ecosystem and build more marketplaces on blockchains where the existing rules of traditional finance can be replicated or perhaps even enhanced. Having said that, I can see some clear issues and potential bottlenecks that come with the process of NFT fractionalization. And this is primarily due to the fact that, firstly, NFT fractions still remain a rather niche subsector that's yet to achieve its full potential. And secondly, because with more NFT or F-NFT marketplaces comes more regulatory scrutiny. Which leads me on to my next point. Now, there's an important distinction to be made between simply storing an asset off-chain and using it as an investment vehicle. Certificates of ownership wrapped within NFT contracts are static rights, and they do not change. So, custody solutions for NFTs are not necessarily subjected to securities laws. However, buying a piece of artwork and storing it in a crypto wallet is a completely different story. This is because the investor is actively allocating capital to an asset with the expectation that it will rise in value and that they can then trade it on for a profit. Furthermore, chances are that the investor wouldn't just be acquiring one NFT fraction, but multiple fractions that would then be assembled in their portfolio, just like stocks and bonds. Now, when aspects of an NFT become revenue and value producing, it quickly moves into the securities realm covered by federal laws, where the same rules apply to digital assets as if the right of ownership was being recorded in the real world. In fact, according to a report by White & Case, the proposition put forward by NFTs brings to bear all of the legal issues that already exist within the process of regulating non-fungible tokens in general. These include intellectual property issues, contract issues, rights of publicity, and other major concerns. The most basic NFT sales involving digital collectibles, which are akin to the sale of highly sought-after artworks at auction, are less likely to be viewed as raising issues around securities laws. However, the concern that F-NFTs may be securities is a bit more pronounced. This is because, given the creativity surrounding the NFT market, certain actions, such as any efforts to build up the market and value surrounding F-NFTs, may raise flags with financial regulators. And efforts to create fractional interests or other similar arrangements could potentially raise questions about whether such actions begin to sound like an investment product that regulators would classify as a security under the Howey test. Now, the Howey test, of course, refers to the US Supreme Court case for determining whether a transaction qualifies as an investment contract. If so, it would therefore be considered a security and subject to disclosure and registration requirements under the Securities Act of 1933 and the Securities Exchange Act of 1934. Now, under the Howey test, an investment contract exists if there is, quote, an investment of money in a common enterprise with a reasonable expectation of profits to be derived from the efforts of others. The Howey test actually applies to any contract, financial scheme, or transaction, and it has proven instrumental for regulators in situating blockchain and digital assets with investors and project backers. Now, compared with more standard NFTs, with F-NFTs, fractional interests tend to be more accessible to a larger number of smaller investors. This has inevitably raised the antennae of the Securities and Exchange Commission, as F-NFTs could technically facilitate the development of their own unregulated trading market. This point was made clear by SEC Commissioner Hester Peirce during the Security Token Summit of 2021. Peirce noted that if someone wanted to place numerous NFTs into one basket and sell F-NFTs, or take on one NFT and sell shards of it, they simply had to make sure that the assets they were creating didn't fall under the official title of an investment product or security. On that note, the SEC and its staff have time and again outlined the agency's position in statements concerning initial coin offerings, ICOs, in a number of prior enforcement actions and in its court action against Ripple. The SEC has also published an official framework for applying the Howey investment contract analysis to digital assets. A framework which identifies a number of characteristics that make a digital asset more or less likely to be viewed as a security. Thus, because of how profitable the NFT market has become over the last 2 years, it was perhaps only natural for the SEC to begin its investigation of the broader NFT sector. A recent report by Bloomberg revealed the SEC's and Gary Gensler's intentions to begin regulatory investigation of the NFT ecosystem. And according to the report, there appear to be 3 main purposes as to why the regulatory body has decided to undergo such procedures. The first is to determine and ascertain what asset class NFTs fall into. Secondly, to determine whether or not NFTs are being used to raise money like traditional securities. And thirdly, to expose and eradicate any illicit operations conducted through these NFTs. Now, a significant amount of focus is being placed on fractionalized NFTs due to the many potential securitization issues that have recently arisen. Now, I can't say that I'm all that surprised about the SEC's planned investigations. In fact, if you follow my weekly newsletter, you'll have seen me talk about this F-NFT regulatory risk several times before. Especially because even though these unique tokens haven't yet received the No Objection Certificate, NOC, and are mainly unregulated, they continue to surge in demand and progressive adoption. I mean, the market data and the trading volume on some of these NFT marketplaces speaks for itself. Only last month, for instance, the total sales of NFTs on OpenSea crossed the $3.5 billion mark. The month before that, sales peaked at almost $5 billion in trading volume. However, It's important to note here that the growing NFT sector, despite being so young, is also opening doors to regulatory threats. This is also why many NFT marketplaces decided to completely delist certain NFT collections that offer royalties or raise funds for businesses. Moreover, potential cyber attacks will unfortunately always loom over these hundreds of thousands and at times millions of dollars of tokens and valuable assets. Now, the most salient and recent example of this was the OpenSea listing exploit, which saw many NFT investors suffering hefty losses and causing one victim to even take the NFT marketplace to court and sue it for $1 million in damages. I mean, in retrospect, it was inevitable. And it was only natural that a lawsuit of this size would catch the regulator's attention and end up backfiring on the entire platform. Now, whether or not the SEC is looking to permanently attack the NFT sector is yet to be known, since subpoenas and investigations don't necessarily denote action. However, it's very unlikely that the SEC will back down easily from this, considering the authorities' historically turbulent relationship with crypto and its recent $100 million penalty to BlockFi for not complying with US regulatory laws. Ultimately, the evaluation of whether NFTs, fractionalized NFTs, and their respective marketplaces will be hit by hefty regulatory penalties is hard to tell. But if the SEC were to go ahead and penalize specific holders and issuers for operating through F-NFTs, this would most likely be determined on a case-by-case basis, given the economic realities of each and every transaction. Now, to my mind, fractionalization is the next logical step in the art of NFT tokenization, as it enables asset holders to do more with idle collateral. And by breaking up a larger and more expensive asset into smaller parts, it makes the entry point more accessible for more investors, which, in my opinion, is a good thing. Furthermore, fractionalization could potentially usher in a new legal framework that not only makes the NFT market more accessible, but also more dynamic. In fact, fractionalizing an asset into smaller parts and selling them to others equates to effectively providing equity. These tokens can then potentially be traded and used as collateral in DeFi protocols for lending purposes. But by fractionalizing an NFT and subsequently borrowing and lending against it, one is technically creating a financial product, i.e. a security, at least according to US regulations. Accordingly, as the NFT market matures, progressive functionalities are implemented, and the SEC becomes increasingly more accepting of blockchain-based assets, it is possible that some form of regulation will be applied to this asset class. Now, while the majority of regulatory investigations into crypto are ongoing in the US, it is still difficult for most people to understand securities laws and how they apply to their assets. Thus, what I deem most important here is that regulators provide clarity so that investors can gain the confidence to engage in this new and exciting asset class. For instance, Germany's supervisory authority has put stakes in the ground, deeming all DLT-issued securities to fall under existing securities laws as part of the amendment to the German banking law in 2020. And while this caused many blockchain proponents to worry, this clear direction actually gives entrepreneurs confidence to build products with regulatory certainty. We've also seen countless examples of coordinated regulatory crackdowns on different sectors of the crypto industry. And given the skyrocketing valuation of the market, it's perhaps naive to think that NFTs and F-NFTs won't be next on the regulators' agendas. Thus, providing clear legal guidelines here will give impetus to the industry to build issuance and trading processes that are compliant and replicable to any asset class, including fractionalized NFTs. And while regulations and penalties for NFT platforms might very well be on the horizon, I expect NFTs to remain an exciting, booming sector of the cryptoverse. Okay, that's the video about done for today, folks. But I'd love to hear your thoughts on fractionalized NFTs, so please don't hesitate to let me know in the comments section down below. Remember to subscribe to the channel and ping that notification bell if you'd like to keep getting the highest quality crypto content on the scene. Be sure to tune in to the Coin Bureau podcast, which is available on all major platforms, and you can also follow me on TikTok, Telegram, Instagram, and Twitter. Subscribing to my weekly newsletter will also make your crypto life infinitely better. It's packed with all the tips and tricks that will make your gains stick. And you may also want to check out my deals page. It's got some of the best crypto deals and promos on the market today. Thank you so much for watching, folks, and I'll see you all very soon. This is Guy bidding you goodbye.